Yep. Hi, my name is Edward Quiliche. I'm an attorney with Simon Haysom LLC, and the purpose of this video is to talk about, basically provide a general description of bankruptcy, both Chapter 7 and Chapter 13, which are typically filed by individuals, to describe for you the circumstances under which it's most appropriate to file bankruptcy under both of those chapters and the impact that they have on mortgages, mortgage foreclosures, and other related topics. Initially, at the outset, I just want to say, this is a general description. Every set of circumstances is different, which is why it's extremely important that if you are thinking of filing a bankruptcy, you should consult an attorney, where you'll have the opportunity to get an assessment of your particular circumstances. So at the outset, I just want to begin by describing 4 different types of debt. The Bankruptcy Code revolves essentially around the type of debt, and how that debt will be treated will be determined by what type of debt that it is. So there are essentially 3 types of debt. There's secured, priority, and unsecured debt, and then as part of unsecured debt, there's also certain non-dischargeable debt. So secured debt is essentially any debt that is secured to property. Most typically it's going to be a car loan or a mortgage, right? Because it's secured either to your house or to your car. A priority debt is a bankruptcy term of art. It just refers to specially classified debts like domestic support obligations, maintenance or child support, or certain tax debts, IRS debt or New York State tax debt. And these types of debts are in a special category, and they're treated differently than other debt, other unsecured debt. And then unsecured debt is essentially everything else. It's your credit card debt, it's medical debt, it's just any type of debt where you owe money but it's not attached to a particular piece of property. Okay, so taking those definitions with us, we'll refer to those types of debts throughout this discussion. All right, so the 2 types of bankruptcy that are typically filed by an individual are either Chapter 7, which refers to a liquidation, which is probably the type of the type of bankruptcy that is that most people know about, or to some degree. And then there's a Chapter 13, which is a reorganization of debt and a repayment of debt through a 5-year plan. So we'll begin with Chapter 7. Chapter 7, as I said, is a liquidation. Now, it's a little bit misleading because most people think that it is a complete liquidation of assets and they use that money to distribute to your creditors, and that's it, and you lose everything and you're out on the street, and that's just not true. What it really is a liquidation of non-exempt assets. In New York State, we have very generous, what they call exemptions. So the idea is bankruptcy is designed to give you a fresh start. It would be counterintuitive to give you that fresh start, but at the same time take away all your dishes and your clothes and your house and your car and leave you homeless on the street. It's just, that's not what they're going to do. So there are categories of exemptions that they give you, and in New York recently they have become considerably generous. For example, depending on what county you live in, if you live in Orange County, your exemption for your home is $125,000 in equity per owner. So if it's a joint filing, you're going to be able to exempt $250,000 in equity. So chances are you're not going to lose your home, especially in today's housing market. In Rockland County and in Westchester County and in the boroughs, it's $150,000 per debtor. And in every other county, it is, well, not in every other county, but the range is essentially from $75,000 and then $125,000 to $150,000. Okay. Other examples for a car: everyone can exempt up to $4,000 in value for one motor vehicle. So if it's a joint, then that would be 2 cars. And there are several other categories of exemptions that protect property that is deemed to be important. This includes 401ks, IRAs, retirement funds of that sort. If you're not using your homestead exemption, you can use what they call wildcard exemptions to sometimes exempt up to $12,000 worth of property that would otherwise not be exemptable. Okay, so that gives you a picture of, in most cases, an individual who files a Chapter 7 bankruptcy, they don't actually lose any property. And at the other end, so it would be a distribution of zero to the unsecured creditors. It takes about 4 months to file a bankruptcy, and at the end, all of your unsecured debt is discharged. So what does that mean? It means that a Chapter 7 is not appropriate if what your main financial problem is your mortgage, or if you're being foreclosed on, or you have financial problems that aren't just credit cards or medical debt or things like that. That being said, Chapter 7 does have an impact on your mortgage. A mortgage essentially can be thought of as in two parts. You have your note, which is the debt. The bank lent you money and you owe that money back at a particular interest rate. So that's one piece. The other piece is the mortgage document. That is a document that you sign that secures that debt to your house. The Chapter 7 discharge does nothing to that aspect. So if you get a discharge in Chapter 7, you default on your mortgage, the bank still has the right to foreclose on your house. However, if they foreclose on the house and they sell that property at a foreclosure sale and it yields less money than what you owe to the bank, well, the Chapter 7 has discharged your personal obligation on that debt, and therefore they cannot pursue you for the difference. So that is an important thing to consider. It's not that common for banks to pursue you for a deficiency like that, but it does happen from time to time. Now, another tool is, let's suppose you had a credit card debt and you were sued. And prior to filing bankruptcy, they obtained a judgment against you. Now, a judgment basically creates a lien, and if you have a judgment against you, that lien, in most cases, will automatically attach to any property that you own in the county in which that lien is obtained. For example, if you have equity in your home and you have a judgment lien against you, that lien could attach to the title, and that would become a secured debt, and it would not be discharged in a Chapter 7 bankruptcy. However, you can, in a lot of circumstances actually, file an additional motion that would avoid that lien and basically reclassify it as an unsecured debt again, and then you would be able to get rid of that judgment lien. But it does require the filing of a motion, and it does require circumstances that would enable you to be successful on that motion, and that would be something that you would have to consult a lawyer about. It's a little bit complicated, but you do, in most circumstances, it can be addressed. Okay, so that's essentially a Chapter 7 bankruptcy. It's most appropriate if your problem is unsecured credit card debt, medical debt, things like that. Now, if you have additional financial problems such as mortgage arrears and you want to save your house, if you have a second mortgage, other circumstances such as, in a Chapter 7, you actually have to qualify. If you make too much money, you can't file a Chapter 7. So in some circumstances, yes, you may have a lot of unsecured debt, but you won't qualify for the Chapter 7, so you have to file a Chapter 13. Other circumstances are when you have assets that you can't exempt, and they are at risk of being liquidated into Chapter 7. So instead, you file a Chapter 13. When you file a Chapter 13, you have no risk of any assets being liquidated, because instead of paying your creditors back by selling off your assets, you're paying them back by the promise of using your future income to pay them back through a plan, a 5-year plan. So let's talk a little bit about that plan and what that looks like. Again, your plan depends on the categorization of debt that I had described previously. So you have a 5-year plan. That 5-year plan is going to include secured debt, now, not just secured debt, but secured arrears. So any payments that you're behind on your mortgage would be included in that plan, and they would be paid back. You would have the opportunity to catch up at 100 cents on the dollar. You have to pay the whole thing back. Priority debt is the same. You have to pay the whole thing back to the IRS or to whoever it is you owe a domestic support obligation, if that's the case. Unsecured debt, on the other hand, is usually paid back at a percentage. And that percentage is on average about 10 cents on the dollar. So, there is a benefit there right at the outset. If you have a large amount of unsecured debt, you can relieve yourself of that burden by, say, for example, if you own $50,000 worth of credit card debt, you would end up paying $5,000 over a period of 5 years, and that is much more manageable rather than paying, if you have $50,000 in credit card debt, chances are you can't even make the minimum interest payment, and you would never get out from underneath that debt. So right there, you have a benefit. Now, there are also additional tools that are available in a Chapter 13 bankruptcy. So there is an additional motion that can be filed. It's called, in term of art, a pawn motion, and what that does is it reclassifies a second mortgage as an unsecured debt. So under circumstances where you have a first mortgage and you owe more on that mortgage than the entire value of your home, and that leaves the second mortgage completely unsecured. If you have 1 penny of security available for that second mortgage, it's not going to work. But if it's completely unsecured, then you can reclassify that second mortgage as an unsecured debt. Now, 2 things can happen there. Either you are filing a Chapter 13 by itself, and then you, say, for example, have a $40,000 home equity line of credit. You would end up paying that back at $4,000, assuming you have a 10% plan for your unsecured debt. You would pay that back at $4,000 over a period of 5 years, which would be very manageable. However, if you previously filed a Chapter 7 prior to your 13, you have already discharged that personal obligation. So when you reclassified it and you got rid of that mortgage, it's gone. You don't have to pay it back at all. And that is a huge benefit for a lot of people, especially in today's housing market where many homes are underwater, and the value of the first mortgage consumes the entire value of the house. Additionally, and you still have access to the other motion where you would get rid of a judgment lien as well, and it works in a similar way, but it just applies to judgment liens where someone has sued you. Now, the other main advantage in a Chapter 13 is that inside of a Chapter 13 you can pursue a loan modification. Now, you can pursue a loan modification in any number of circumstances. You can do it privately between, just between the borrower and the lender. In many cases during foreclosure in New York State, you have mandatory settlement conferences, the primary purpose of which is to negotiate a loan modification. And they have a similar proceeding inside of bankruptcy, which are called loss mitigation proceedings. Now, I have negotiated loan modifications in all 3 scenarios. And by far the rate of success in obtaining a loan modification is highest when it's inside of bankruptcy, and that's for a number of reasons. If you have ever applied for a loan modification, you know the experience where you have submitted an entire package of documents and one of several things happens. The bank never gets it, and then you have to resubmit the entire thing again. They did get it, but they tell you that something is missing, that you know isn't missing. So you submit that thing, and then by the time they look at it, they tell you that all of the other documents that they said they already had in the first place have gone stale, and then you have to resubmit, and you get into this cycle where you've submitted 7 applications and no one has ever given you any indication about whether or not you're actually going to qualify for a loan modification. And if you're in circumstances where you're already behind on your mortgage and those arrears continue to stack up month after month, every month that goes by that the bank delays, you're going to have less of a chance of getting a loan modification because it's harder to modify a mortgage where you have more and more past due interest payments and escrow advances and things like that. So inside of bankruptcy, it's a little different because it is under the jurisdiction of a federal bankruptcy judge. And the attorneys appear once a month at status hearings, and the attorney for the bank and the attorney for the borrower stand in front of the court and they tell the judge where exactly they are in the negotiations. So that brings about two things that really help move things along. First of all, attorneys, for some reason, appear to be more effective at keeping track of document submissions than banks do. We have emails that are stamped, the date stamped, and we can show the judge every time a submission was delivered to the bank on what date it was, and then the judge can quickly see how long it's taking the bank to look at that document, that set of documents. And when it takes 1 or 2 or 4 months for them to get back to you on that set of documents, the judge is going to understandably get upset with the bank. And what's more is that the federal bankruptcy judge has the power to subpoena a bank officer or even a bank president